Hello and welcome to Wealth. We all know Warren Buffett is one of the most famous and successful investors of all time. His net worth is over $135 billion. But even more impressive than his wealth is the fact that he built his fortune through patience, discipline, and smart long-term investments. Today, we'll share Warren's best advice for young people who want to get rich. Now, we're not saying you need to be a billionaire to be happy, but implementing some of Warren's proven money tips at a young age can set you up for financial freedom down the road. Shall we get started? Here's the sage wisdom on wealth from one of the world's greatest investors. Focus on building skills, not getting rich quick.
You could improve many of you, and I certainly could have when I got out, just in terms of learning communication skills. You know, it's not something that's taught. I actually went to a Dale Carnegie course later on in terms of public speaking, but if you improve your value 50% by having better communication skills, that's, it's another $500,000, in terms of capital value. See me after the class and I'll pay you,
A lot of young people nowadays are attracted to hot stock tips, cryptocurrencies, NFTs, and quick ways to make money. But Warren warns against trying to get rich quick. His main advice? Spend your time and energy building skills, expertise, and knowledge instead. As Warren puts it, if you want to get rich, don't focus on getting rich. Focus on becoming genuinely worth something.
The best thing you can do is to be exceptionally good at something. If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. Somebody else will give you some of the wheat they produce or the cotton or whatever it may be, and they will trade you for the skill you have. So the best investment by far is anything that develops yourself.
Rather than chasing overnight success, focus on developing talents and skills that the world values. That's the surest path to wealth over the long run. For example, think about the skills that are well compensated in today's economy. Things like computer programming, marketing, accounting, medicine, and law. Pick something you enjoy and are good at, then dedicate yourself to mastering it. With enough time and dedication, you can become an expert in your field, and experts tend to make very good livings. The key is patience and dedication. Getting rich slowly by providing enormous value is better than hoping to luck out with a hot stock. As Warren says, the earlier you start becoming genuinely useful, the richer you'll end up. So find something useful and meaningful to dedicate yourself to early on. The money will follow. Understand the magic of compounding.
Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
Another key piece of Warren's advice? Grasp the power of compound interest and let it work its magic. Compound interest is when you earn interest not only on your money, but also on the interest itself. Over decades, even modest annual returns can snowball into fortunes through compounding. As Warren colorfully puts it, you want to be the ox who steadily plods through the fields, not the hare who races and bursts then sleeps in between. Let's break down the math with an example. Say you invest $5,000 at age 20 and contribute another $5,000 each year until age 30. So $50,000 contributed in total over 10 years. If your investments earn an 8% average annual return, by 60, your portfolio would grow to over $1.4 million, even if you never invested another dollar after age 30. That's because in later years, you earn returns not only on your original investments, but on all the accumulated interest and dividends. The key ingredients are starting early, reinvesting all gains, and giving the magic of compounding time to work. As Warren says, the earlier you start investing, the more financial compounding you can achieve. So even if you're young and funds are limited now, Start contributing and investing whatever you can afford regularly. Time and compounding can help grow it into a fortune. Live below your means. Here's another classic piece of Buffett advice. Live significantly below your means. Despite being one of the richest people alive, Warren lives fairly modestly given his vast fortune. He still resides in the same home he bought in 1958 and drives older cars he picks up at auction. Warren's frugal habits not only help him preserve capital to keep reinvesting, they also give him the freedom to focus on what matters rather than being burdened by a lavish lifestyle. As he says, "I have everything I want, but I don't have everything there is." For most of us non-billionaires, living below our means comes with major lifestyle benefits too. We can avoid debt, stress less about bills, save and invest more money, and retain the freedom to pursue meaningful goals not tied to money. A good guideline? Try spending significantly less than you earn. Savings guru Mr. Money Mustache recommends saving at least 50% of your take-home pay. He shows how you can live very comfortably on a fraction of what most people spend by making smart lifestyle choices. For example, you can drive used economy cars, bike and walk more, pursue free and low-cost entertainment. Little savings add up substantially. Invest the difference, and compound interest can help you grow your nest egg into something that one day supports financial independence. Keep investing simple and boring.
I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America. If I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. In investing, there's no called strikes. People can throw Microsoft at me and you name it, any stock, General Motors, and I don't have to swing.
Warren Buffett's #1 investing rule? Keep it simple and boring. No frantic trading, no speculative bets, just steady, disciplined, long-term investing focused on productive assets. As Warren famously put it, the stock market is designed to transfer money from the active to the patient. Rather than trying to beat the market and find the next big thing, he says average investors are better off with passive buy and hold investing. What does this look like in practice? Primarily investing in low-cost stock index funds that track whole market indexes like the S&P 500. These give you instant diversification across hundreds of large companies without requiring stock-picking expertise. Warren made a famous $1 million bet that an S&P 500 index fund would outperform a collection of hedge funds over 10 years. The index fund won handily, even after fees. With index funds, you can enjoy the long-run average returns of 8 to 10% per year that stocks deliver without stressing about picking individual winners. Now, this buy and hold strategy requires patience and discipline. There will always be exciting investment fads and short-term market drops that tempt you to change course. But historically, those who stick to their investing plans fare better in the long run. As Warren wisely notes, games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. Tune out the noise, make steady contributions regardless of market conditions, reinvest the dividends, and give the magic of compounding time to grow your nest egg. Lastly, the best of Warren Buffett's advice for young people seeking to build wealth over the long haul. His tips may not promise overnight success or get-rich-quick schemes, but they set the stage for real, lasting wealth decades down the road. At the core, Buffett urges focusing on building genuine expertise, skills, and knowledge rather than chasing quick bucks. Become truly good at something valuable, and financial success will follow. He also emphasizes harnessing the incredible power of compound interest by starting to invest early and sticking to it. Even modest savings can snowball into a fortune in time when you let compounding work its magic year after year after year. Additionally, Buffett advocates living well below your means, avoiding lifestyle inflation even as your income grows. Invest the difference, and compounding returns can accelerate your wealth accumulation flywheel. And importantly, he counsels keeping your personal investing basic and boring, primarily through passive index funds that track the overall market's long-run upward trajectory. Avoid the temptation to trade frantically or chase speculative fads. Now, building wealth the Buffett way certainly takes patience, discipline, and sacrifice. But his proven prescription sets you up to amass serious wealth and freedom in the coming decades. You might not get rich quick if you start early, spend less than you earn, invest regularly in indexes, and let compounding grow your nest egg. But you may very well end up rich and able to live life on your own terms. Well, there you have it, Warren's best tips for building long-term wealth. If you found this video helpful, be sure to like, subscribe, and click the notification bell to catch more content to enrich your financial journey. Until next time, here's wishing you disciplined investing and compounding returns ahead.